The year was 2008. The world was reeling from a financial crisis. Trust in traditional systems was shaken. People were looking for answers, for alternatives. It was in this climate of uncertainty that a new idea emerged: Bitcoin. It was a radical concept, a digital currency, free from government control, operating on a revolutionary technology called blockchain. Bitcoin was more than just code. It was a vision of a more equitable financial system, where power resided with the people. A world where transactions were transparent, secure, and accessible to all. The mysterious Satoshi Nakamoto, the pseudonymous creator of Bitcoin, vanished into the digital ether, but their creation had sparked a revolution. The epic journey of cryptocurrency had begun. On January 3rd, 2009, the first block of the Bitcoin blockchain was mined. This Genesis block, as it came to be known, marked the birth of Bitcoin as a functioning network. Embedded within this first block was a message. The Times, 03 Jan 2009, Chancellor on brink of second bailout for banks. This act was deliberate, a statement woven into the very fabric of Bitcoin. It declared independence from the existing financial systems that seemed so fragile and untrustworthy. The seeds of a global phenomenon were sown.
Bitcoin introduced the world to the concept of peer-to-peer digital cash. For the first time, people could transact directly with each other, without the need for intermediaries like banks or payment processors. This had profound implications. Imagine a world where you could send money to someone across the globe as easily as sending an email, with minimal fees and without the need for a bank account. Bitcoin's decentralized nature was key to its appeal. No government or corporation could shut down Bitcoin, seize funds, or devalue the currency.
As Bitcoin gained traction, it inevitably faced pushback. Governments around the world grappled with how to regulate this new and unfamiliar technology. Some saw it as a threat to their monetary sovereignty, while others worried about its potential use in illicit activities. The media was awash with stories about Bitcoin's volatility, its association with the dark web, and its potential for fraud. Yet, despite these challenges, Bitcoin endured. The idea of a decentralized, immutable ledger had far-reaching implications for industries ranging from finance to healthcare.
In the early days, Bitcoin existed in a sort of digital vacuum, its value theoretical at best. But on May 22, 2010, something remarkable happened. A programmer named Laszlo Hanyecz made history by buying 2 pizzas with 10,000 Bitcoin. This seemingly ordinary transaction marked a watershed moment, a tangible demonstration of Bitcoin's potential as a real-world currency. The pizza purchase gave Bitcoin a real-world price anchor. It proved that this digital currency could actually be used to buy goods and services. News of the pizza purchase spread like wildfire through the burgeoning Bitcoin community. It sparked excitement, debate, and a surge of interest in this novel form of money.
As Bitcoin gained notoriety, it attracted attention from a diverse range of individuals and groups, including those operating outside the bounds of traditional systems. In 2011, a website called Silk Road emerged on the dark web, an anonymized portion of the internet accessible only through specialized browsers. Silk Road was an online marketplace where users could buy and sell illicit goods, primarily drugs, using Bitcoin as the sole currency. The use of Bitcoin on Silk Road was no accident. Its pseudonymous nature and decentralized structure made it difficult for law enforcement to track transactions and identify buyers and sellers. While Silk Road was eventually shut down by authorities in 2013, its brief existence had a profound impact on the public perception of Bitcoin.
As Bitcoin gained traction, exchanges emerged to facilitate the buying and selling of the cryptocurrency. Among these, Mt. Gox, established in 2010, rose to prominence, becoming the largest Bitcoin exchange in the world. handling over 70% of all Bitcoin transactions at its peak. Mt. Gox's success, however, was short-lived. In February 2014, the exchange suspended trading, citing technical issues. What followed was a cascade of revelations that sent shockwaves through the Bitcoin community. Mt. Gox had been hacked, and a staggering 850,000 Bitcoin, worth hundreds of millions of dollars at the time, had been stolen. The collapse of Mt. Gox was a devastating blow to the fledgling Bitcoin ecosystem. It underscored the importance of security, regulation, and the need for more robust infrastructure to support the growing adoption of Bitcoin.
As Bitcoin gained popularity, the limitations of its underlying technology became increasingly apparent. The Bitcoin blockchain could only process a limited number of transactions per second, leading to network congestion and rising transaction fees. This sparked a heated debate within the Bitcoin community about how to scale the network to accommodate growing demand. One faction proposed increasing the block size limit to process more transactions per second. Another faction opposed this change, arguing that it would centralize Bitcoin mining and compromise the security of the network. This impasse led to a contentious hard fork of the Bitcoin blockchain in August 2017, resulting in the creation of Bitcoin Cash.
While the Bitcoin community grappled with scaling and governance issues, a new blockchain platform, Ethereum, burst onto the scene in 2015, offering a fresh perspective on the potential of cryptocurrency and blockchain technology. Created by Vitalik Buterin, Ethereum went beyond Bitcoin's focus on digital currency. Ethereum introduced the concept of smart contracts, self-executing contracts that could automate complex transactions and agreements. This opened up a world of possibilities for decentralized applications, from decentralized finance or DeFi to non-fungible tokens or NFTs. Ethereum's native cryptocurrency, Ether, quickly gained popularity, becoming the second largest cryptocurrency by market capitalization. Ethereum's emergence marked a turning point in the cryptocurrency landscape, expanding the scope of blockchain technology beyond digital currency.
Ethereum's innovative platform and the rise of smart contracts gave birth to a new fundraising mechanism, the Initial Coin Offering, or ICO. ICOs allowed startups to raise capital by issuing their own tokens on the Ethereum blockchain, bypassing traditional venture capital and regulatory hurdles. The ICO boom of 2017 saw a frenzy of activity, with hundreds of projects raising millions of dollars, often with little more than a white paper and a website. This Wild West atmosphere attracted both legitimate entrepreneurs and unscrupulous actors looking to capitalize on the hype. As with any gold rush, the ICO boom was followed by an inevitable bust. Despite its shortcomings, the ICO boom left an indelible mark on the cryptocurrency landscape.
As the cryptocurrency market matured, it began to attract the attention of institutional investors, hedge funds, and traditional financial institutions, drawn by the potential for high returns and the emergence of more regulated investment vehicles. The launch of the first Bitcoin futures contracts on the Chicago Board Options Exchange, or CBOE, in December 2017 marked a watershed moment, providing institutional investors with a regulated avenue to gain exposure to Bitcoin. This institutional interest led to the creation of specialized cryptocurrency funds, offering investors diversified exposure to the asset class. These funds, managed by experienced professionals, provided a more regulated and accessible way for institutional and high-net-worth individuals to participate in the cryptocurrency market. The influx of institutional capital brought a degree of legitimacy and stability to the cryptocurrency market. It also signaled a growing acceptance of cryptocurrency as a legitimate asset class.
Section 8. The Lightning Network, a glimmer of scalability. While the Bitcoin community remained divided on the best approach to scaling the network, a promising solution emerged. The Lightning Network. Proposed in 2015, the Lightning Network is a Layer 2 scaling solution that operates on top of the Bitcoin blockchain. The Lightning Network enables near instantaneous, low-fee transactions by creating a network of payment channels between users. These off-chain transactions are only settled on the Bitcoin blockchain when the payment channel is closed, significantly reducing the load on the main chain. The Lightning Network offered a potential solution to Bitcoin's scalability woes, enabling it to handle a much larger volume of transactions without compromising its core principles of security and decentralization. While still in its early stages of development, the Lightning Network represents a glimmer of hope for Bitcoin's long-term viability as a global payment system.
The evolution of blockchain. Blockchain, the backbone of Bitcoin, has evolved significantly. Its transparency, immutability, and decentralization open doors to many applications. Ethereum introduced smart contracts, transforming blockchain into a programmable platform. New consensus mechanisms like POS and DPoS aim to make blockchain more sustainable. These advancements promise broader adoption across various industries.
Section 2. The rise of altcoins. The rise of altcoins has been one of the most dynamic aspects of the crypto landscape. Each altcoin aims to address specific limitations of Bitcoin or explores new use cases for blockchain technology. Ethereum, launched in 2015, introduced smart contracts, enabling decentralized applications. This opened up possibilities from decentralized finance to non-fungible tokens. Ethereum's success inspired countless other projects. Litecoin offers faster transaction times and a different cryptographic algorithm. Ripple focuses on real-time international payments. Chainlink provides a decentralized Oracle network for smart contracts. The proliferation of altcoins has led to a highly competitive and innovative environment.
Smart contracts extend blockchain utility beyond simple transactions to complex, automated agreements. Introduced by Ethereum, they are self-executing contracts with terms written into code. Applications range from financial services to supply chain management. In finance, they automate loans, insurance claims, and trading. In supply chains, they provide transparency and traceability. Beyond finance, they impact healthcare, real estate, and governance.
Decentralized finance, or DeFi, represents a paradigm shift in the financial industry. DeFi platforms offer lending, borrowing, trading, and investing without traditional banks. By removing intermediaries, DeFi offers lower fees and faster transactions. Anyone with an internet connection can access DeFi services globally. Decentralized exchanges, DEXs, allow direct cryptocurrency trading. Yield farming offers new opportunities for passive income. However, DeFi's rapid growth has led to vulnerabilities and exploits. Despite challenges, DeFi continues to grow and innovate.
Non-fungible tokens, or NFTs, have redefined digital ownership, sparking a new era of digital art and collectibles. NFTs are unique digital assets representing ownership of specific items on the blockchain. They provide artists, musicians, and creators new ways to monetize their work. Tokenizing creations allows direct sales to collectors with proof of authenticity. This model reduces intermediaries, letting creators retain more revenue. NFTs have revolutionized collectibles, from virtual trading cards to in-game items. These assets are often limited, creating scarcity and driving demand. Platforms like OpenSea and NBA Top Shot have seen explosive growth.
Scalability is a major challenge for Bitcoin and Ethereum. As demand grows, faster transaction processing is needed. Layer 2 solutions are promising for scalability. They process transactions off-chain, reducing load and costs. Examples include the Lightning Network for Bitcoin and optimistic rollups for Ethereum. These solutions bundle transactions and submit proofs to the blockchain. This maintains security and increases throughput. Scalability solutions are key for blockchain's future.
As blockchain networks proliferate, interoperability, the ability for different blockchains to communicate, is essential. It creates a seamless ecosystem where assets and data move freely. Polkadot, by Ethereum co-founder Gavin Wood, enables data and asset transfer between blockchains. Cosmos focuses on an internet of blockchains using its IBC protocol. This fosters collaboration and innovation, breaking down silos. Interoperability enables decentralized applications to leverage multiple blockchains. As these solutions evolve, they will integrate and mature the blockchain ecosystem.
Quantum computing poses challenges and opportunities for blockchain and cryptocurrency. Quantum computers perform complex calculations at unprecedented speeds, disrupting traditional cryptographic systems. The primary concern is that quantum computers could break cryptographic algorithms underlying blockchain security. Elliptic curve cryptography could be vulnerable to quantum attacks. Researchers are exploring quantum-resistant cryptographic algorithms to address this threat. These new algorithms aim to secure blockchain networks in a post-quantum world. Projects like NIST's post-quantum cryptography standardization are leading the way. The intersection of quantum computing and blockchain holds potential for groundbreaking innovations.
Governments take notice. The early days of crypto regulation. The emergence of Bitcoin and subsequent cryptocurrencies presented a novel challenge to governments and regulatory bodies worldwide. Here was a new form of money, operating outside the traditional financial system, with the potential to disrupt established monetary policies and challenge the very notion of centralized control. In the early days, reactions were mixed. Some governments, wary of Bitcoin's decentralized nature and potential for illicit use, took a cautious approach, issuing warnings to consumers about the risks associated with cryptocurrencies. Others, intrigued by the potential of blockchain technology, adopted a more wait-and-see approach, observing the development of the crypto ecosystem before taking concrete regulatory steps. One of the earliest instances of government intervention occurred in 2013, when the US Financial Crimes Enforcement Network, or FinCEN, issued guidance clarifying that certain cryptocurrency businesses, such as exchanges and payment processors, fell under existing anti-money laundering and know your customer regulations. This marked a turning point, signaling that governments were beginning to recognize cryptocurrency as a legitimate financial activity requiring regulatory oversight. The Silk Road marketplace, operating on the dark web and utilizing Bitcoin for illicit transactions, further fueled concerns among regulators about the potential for criminal activity within the crypto space. The shutdown of Silk Road in 2013 and subsequent arrests highlighted the challenges of policing a decentralized and pseudonymous financial system.
Navigating the gray areas, regulatory uncertainty and legal challenges. As the cryptocurrency ecosystem grew and evolved, so too did the complexities surrounding its regulation. The decentralized nature of cryptocurrencies, operating across borders and beyond the control of any single entity, presented unique challenges for regulators accustomed to dealing with traditional financial institutions. One of the primary challenges was, and continues to be, the classification of cryptocurrencies. Are they currencies, commodities, securities, or something else entirely? This fundamental question has been the subject of much debate, with different jurisdictions adopting varying approaches. This lack of regulatory clarity created uncertainty for businesses operating in the crypto space, hindering investment and innovation. The rapid emergence of new cryptocurrencies and blockchain-based business models further complicated matters. Initial coin offerings, which exploded in popularity in 2017, allowed startups to raise capital by issuing their own tokens. This novel fundraising mechanism fell into a regulatory gray area, with many ICOs operating without proper oversight or investor protection. The lack of clear regulatory frameworks also led to legal challenges and disputes. Businesses operating in the crypto space faced difficulties obtaining banking services, registering with regulatory bodies, and complying with existing laws that were not designed with cryptocurrencies in mind. This legal uncertainty created a barrier to entry for many legitimate businesses and stifled the growth of the industry.
Silk Road and beyond. The battle against illicit activities. The use of Bitcoin on Silk Road highlighted crypto's potential for criminal exploitation. Cryptocurrency's pseudonymous nature made them attractive for illicit activities. The shutdown of Silk Road in 2013 marked a turning point. Law enforcement began developing tools to trace crypto transactions. Realizing transactions could be traced led to numerous arrests. Despite efforts, the battle against crypto crime continues. Criminals adapt, using privacy coins and mixers to evade detection. The borderless nature of crypto requires international cooperation. Regulatory bodies strengthen anti-money laundering regulations. Exchanges must verify identities and monitor transactions. These measures aim to hinder criminals while protecting legitimate users.
The inherent volatility of cryptocurrencies like Bitcoin, while attractive to traders and speculators, posed a significant barrier to mainstream adoption. The wild price swings made it difficult for businesses to accept cryptocurrencies as payment and for individuals to use them for everyday transactions. This is where stablecoins entered the scene, offering a solution to the volatility problem and bridging the gap between the crypto world and traditional finance. Stablecoins are cryptocurrencies designed to maintain a stable value, typically pegged to a fiat currency like the US dollar or a basket of assets. This stability is achieved through various mechanisms, including collateralization, where the stablecoin issuer holds reserves of fiat currency or other assets equal to the value of the stablecoins in circulation. The emergence of stablecoins had a profound impact on the cryptocurrency ecosystem. They provided a more stable and predictable medium of exchange for crypto transactions, facilitating trading, lending, and other DeFi activities. Stablecoins also made it easier for businesses to accept crypto payments without worrying about price fluctuations. However, the rapid growth of stablecoins also raised concerns among regulators. Unlike other cryptocurrencies, stablecoins have the potential to impact monetary policy and financial stability, especially if they achieve widespread adoption. This led to increased scrutiny from regulators, particularly regarding the reserves backing stablecoins and the transparency of their operations.
The rise of cryptocurrencies and stablecoins did not go unnoticed by central banks around the world. As the guardians of national currencies and monetary policy, central banks began exploring the potential of issuing their own digital currencies, known as central bank digital currencies, CBDCs. CBDCs are digital representations of a country's fiat currency issued and backed by the central bank. Unlike cryptocurrencies, which are decentralized and operate independently of central banks, CBDCs are centralized and under the full control of the issuing central bank. This gives central banks a high degree of control over the issuance, distribution, and use of CBDCs. The motivations behind CBDC development vary by country. Some see CBDCs as a way to improve the efficiency and reduce the cost of payment systems, particularly for cross-border transactions. Others view CBDCs as a tool to enhance financial inclusion, providing access to digital financial services to unbanked and underbanked populations. The potential implications of CBDCs are far-reaching. They could reshape the financial landscape, challenging the role of commercial banks and altering the way money is created, distributed, and used. The introduction of CBDCs could also have significant implications for privacy, monetary policy, and the international monetary system. The future of crypto regulation. The regulatory landscape for cryptocurrencies is evolving rapidly. Balancing innovation with consumer protection is a key challenge. Stablecoins will likely face increased scrutiny. Stricter requirements for reserves and transparency are expected. DeFi's rapid growth has outpaced regulatory frameworks. Greater clarity and international cooperation are crucial. The future of crypto regulation involves balancing innovation and protection.
Section 1. The global impact of decentralized finance. Imagine a world where access to financial services is no longer determined by geographical location or socioeconomic status. A world where anyone, regardless of their background, can access loans, savings accounts, and investment opportunities with transparency and ease. This is the transformative potential of decentralized finance, or DeFi, a rapidly evolving sector within the cryptocurrency ecosystem poised to reshape the global financial landscape. DeFi platforms, built on blockchain technology, operate independently of traditional financial intermediaries like banks. They leverage smart contracts to automate financial services, eliminating the need for intermediaries and their associated fees. This allows for greater accessibility, transparency, and efficiency, particularly for the unbanked and underbanked populations around the world. The implications of DeFi's global impact are far-reaching. For developing nations with limited access to traditional banking infrastructure, DeFi offers a lifeline. Small businesses can access loans and lines of credit. Individuals can send and receive remittances with lower fees, and savers can earn interest on their deposits, all through transparent and secure platforms. Moreover, DeFi fosters financial sovereignty, giving individuals greater control over their assets and financial decisions. Without the need for intermediaries, users have direct ownership and control over their funds, reducing the risk of censorship, seizure, or manipulation by third parties. This empowerment is particularly significant in regions with political instability or limited financial freedom.
Section 2. A new era of financial inclusion. For far too long, access to financial services has been a privilege enjoyed by a select few. Traditional financial systems, with their complex regulations, high barriers to entry, and inherent biases, have excluded billions of people around the world, particularly in developing nations and marginalized communities. Cryptocurrency and decentralized finance have the power to change this narrative, ushering in a new era of financial inclusion where access to financial services is a right, not a privilege. By leveraging blockchain technology's inherent properties of transparency, security, and accessibility, DeFi platforms can empower individuals and communities previously excluded from the formal financial system. Imagine a farmer in rural India, previously unable to access credit from traditional banks due to lack of collateral or credit history, now able to secure a loan through a DeFi lending platform, using their livestock or crops as collateral. Or a migrant worker in the United States, sending remittances back to their family in their home country with minimal fees and near instantaneous transactions through a blockchain-based remittance platform. These are just a few examples of how cryptocurrency and DeFi are breaking down barriers to financial inclusion. By providing access to essential financial services like payments, savings, and credit, DeFi empowers individuals, fosters economic growth, and creates a more equitable and inclusive global financial system.
Section 3. Reshaping traditional systems. Blockchain beyond finance. While the impact of cryptocurrency and blockchain technology on the financial industry is undeniable, its transformative potential extends far beyond the realm of finance. From supply chain management and healthcare to education and voting, blockchain technology is poised to reshape traditional systems across various industries, increasing efficiency, transparency, and trust. In supply chain management, blockchain technology can track the movement of goods from origin to consumer, creating a transparent and immutable record of each step in the process. This enhances traceability, reduces fraud and counterfeiting, and improves efficiency by automating processes and reducing paperwork. In healthcare, blockchain technology can revolutionize the way patient data is stored, shared, and managed. By creating a secure and tamper-proof record of patient information, blockchain can enhance data privacy, improve interoperability between healthcare providers, and streamline medical research. Imagine a world where patients have greater control over their medical records, and doctors can access comprehensive patient histories securely and efficiently. Blockchain technology also holds immense potential for improving governance and promoting democratic processes. By enabling secure and transparent voting systems, blockchain can reduce the risk of voter fraud, increase voter turnout, and restore trust in elections. Imagine a world where voting is accessible, secure, and tamper-proof, empowering citizens and strengthening democratic institutions.
Section 4. The future of work in a decentralized world. The rise of cryptocurrency and blockchain technology is not only transforming industries, but also reshaping the nature of work itself. The traditional model of centralized employment is being challenged by the emergence of decentralized autonomous organizations, or DAOs, and the growing gig economy, creating new opportunities for individuals to work and earn income in a more flexible and autonomous manner. DAOs are organizations governed by smart contracts on a blockchain, allowing for decentralized decision-making and distribution of rewards. Members of a DAO can contribute their skills and expertise to projects and initiatives aligned with their interests, earning tokens or other forms of compensation for their contributions. The gig economy, characterized by short-term contracts and freelance work, is also being enhanced by blockchain technology. Platforms built on blockchain can connect freelancers with clients globally, facilitate secure and transparent payments, and reduce the need for intermediaries, empowering individuals to monetize their skills and build their own businesses. This shift towards a more decentralized and autonomous work environment has the potential to create a more equitable and inclusive labor market, where individuals have greater control over their work, their time, and their income. It also allows for greater flexibility and mobility, enabling individuals to work remotely and collaborate with others across geographical boundaries.
Section 5. The Metaverse and the Convergence of Digital and Physical Realities. As cryptocurrency and blockchain technology continue to evolve, they are converging with other emerging technologies such as virtual reality and augmented reality to create immersive digital experiences and blur the lines between the physical and digital worlds. This convergence is giving rise to the metaverse, a collective virtual shared space where users can interact with each other, participate in experiences, and even own digital assets. Cryptocurrency and blockchain technology play a crucial role in the metaverse by providing a secure and transparent infrastructure for digital ownership, transactions, and governance. NFTs, or non-fungible tokens, enable users to own and trade unique digital assets within the metaverse, such as virtual real estate, avatars, and digital art. Imagine attending a virtual concert with friends from around the world, owning a piece of virtual real estate where you can build and customize your own digital home, or even participating in a virtual economy where you can earn and spend cryptocurrency. These are just a few examples of the possibilities that the metaverse unlocks. The convergence of cryptocurrency, blockchain, and immersive technologies has the potential to revolutionize the way we live, work, and interact with each other. As the metaverse evolves, it will create new opportunities for entertainment, commerce, education, and social connection, blurring the lines between the physical and digital realms.
Cryptocurrency represents a fundamental shift in how we think about trust. Traditional systems rely on centralized institutions like banks and governments. Cryptocurrency is built on trustlessness, relying on blockchain technology. The blockchain ensures transparency and security without intermediaries. Transactions are verified and recorded, making tampering nearly impossible. This shift has profound implications, reducing corruption and increasing accountability. Imagine transparent supply chains, secure voting, and efficient transactions without intermediaries. The evolution of trust through cryptocurrency and blockchain can reshape industries and empower individuals.
The journey of cryptocurrency, from its humble beginnings to its current status as a global phenomenon, has been marked by triumphs and challenges. Embracing the transformative potential of this revolutionary technology, regulatory clarity is a pressing challenge. Unclear regulations hinder innovation and increase fraud risks. Governments must develop adaptable frameworks. The environmental impact of energy-intensive mining is another challenge. Prioritizing sustainability is crucial. Despite challenges, the future of cryptocurrency is bright. New innovations and applications emerge regularly. Expect a more stable, secure, and inclusive crypto ecosystem. As we navigate challenges and embrace opportunities, we shape the future of finance and society.
Imagine a world where financial services are accessible to all, where transactions are transparent and secure, and where individuals have greater control over their data and assets. This is the promise of cryptocurrency, a future where the power of technology is harnessed to create a more equitable and just society. The symphony of change orchestrated by cryptocurrency is composed of many instruments. There's the driving rhythm of blockchain technology, the foundation upon which this new world is built. There's the soaring melody of decentralization, empowering individuals and communities to break free from the constraints of centralized systems. And there's the harmonious blend of innovation and collaboration, as a global community of developers, entrepreneurs, and enthusiasts work together to build a better future. This symphony is still in its early movements, but its impact is already being felt around the world. From the bustling streets of megacities to the remote villages of developing nations, cryptocurrency is empowering individuals, fostering economic growth, and creating new opportunities. The future of money is being rewritten, and it's a future where everyone has a seat at the table. It's a future where financial inclusion is a reality, not a dream. It's a future where the power of technology is used to empower, not to control.
The true potential of cryptocurrency extends far beyond its current applications. As the technology matures and adoption grows, we can only begin to imagine the transformative possibilities that await us. Imagine a world where supply chains are transparent and traceable, reducing fraud and waste. Imagine healthcare systems where patient data is secure and easily shared between providers, improving care and reducing costs. Imagine voting systems that are tamper-proof and accessible to all, restoring trust in democracy. These are just a few glimpses into a future powered by cryptocurrency and blockchain technology. A future where trust is decentralized, transparency is the norm, and the power of innovation is accessible to all. It's a future where the limitations of the past no longer constrain us, and the only limit is our imagination. This future is not guaranteed. It's up to us to build it. It requires us to embrace the challenges, to learn from our mistakes, and to never stop innovating. It requires us to work together, to share our knowledge, and to build a global community united by a shared vision of a better future. The journey ahead may be long, but the destination is worth striving for. The future awaits, and it's full of possibilities.